Hello and welcome to ABC News. I'm Ros Childs. The Reserve Bank is about to hand down its interest rate decision. Many economists believe that there will be an increase in rates, but there's still an outside chance that the Reserve Bank will sit on its hands and keep the cost of borrowing on hold. So we have our business team on hand for the decision. David Taylor is joining us with his analysis from the Reserve Bank in Sydney, and Alicia Barry is with me in the studio. Alicia, can I start with you? What are you expecting?
Well, I'm going to go with the consensus here. I mean, money markets are pricing in a 70% chance that we will see the first RBA decision of the year mean the cash rate goes up to 3.85%. And most economists also think that's the case on account of the hotter than expected inflation number we received last week for the December quarter. Although this isn't a high conviction call from me, I do see the chance that the RBA could, as you say, Ros, hold and deliver a hawkish hold.
Now to business correspondent David Taylor, who is at the Reserve Bank. Hi there, David. So what do you think? Will they or won't they?
A brilliant answer there from Alicia Barry. Look, for me, it's too hard to call. The financial markets have been wrong on numerous occasions. There is a strong case to hike rates, no question about it. Labour market's tight. The trimmed mean, or the underlying inflation, is above the target. North of 3.5%, the target's 2.5%. The Reserve Bank's mandate is to get that figure down to 2.5%. It's not budging at the moment, so they're failing on their central mandate. In addition to that, as a number of investment banks have pointed out, productivity is too low. So when wages rise, it lifts per unit costs for firms, and they pass that on in terms of higher prices. So it's not looking good as far as a rate hike is concerned, but at the same time, are mortgage borrowers really going to pay the price for spending elsewhere in the economy? Not necessarily mortgage borrowers that are spending up big and lifting inflation. So there's an unfairness to this. I'm going to interrupt
David, and we'll go to Alicia because there is an announcement.
In breaking news, the RBA has delivered an increase in the cash rate from 3.6% to 3.85%. It's the first decision of the RBA's calendar year, and this was a widely expected move, with financial markets pricing in a 70% chance of a hike, and the majority of economists betting the same thing after that hotter than expected inflation number received for the December quarter last week. So recapping, the RBA has lifted the cash rate by 25 basis points, or a quarter of a percentage point, to 3.85%. Now, if the banks decide to pass this interest rate increase on in full, it's going to cause extra pain for those with mortgages. For a 25-year loan on an average interest rate at $600,000 a year, borrowers will pay around an extra $90 a month. Now, for those with a mortgage of $1 million, that goes up to around $150 a month. And you can see there those payments at various levels of mortgage and interest rate and mortgage repayments. So let's say for an average $700,000 loan, the repayments per month will increase $105 per month, and that is over a 25-year horizon. Now, CanStar has put together that research. It says if there has been a 25 basis point hike, which there of course have, then an average variable rate now would go up to around 5.77%. When it comes to savers, they obviously are set to benefit from this, and CanStar says with an increase in interest rates that we've seen, a competitive savings rate would be about 4.5%. So standing by for us is Chief Economist at EY, Sherelle Murphy. Sherelle, this is not a surprise.
No, that's right. We've certainly seen the inflation numbers pick up recently, and as the bank says in its statement, materially, in fact, in the second half of 2025, which is, of course, the reason that they've decided that they had no choice but to put the cash rate up today to 3.85%. It is disappointing because, of course, it was less than 6 months ago that the Reserve Bank was cutting rates, and in fact, there's been a very sharp change in expectations over over what's happened over the last 6 months. I think also that's quite unusual in the sense that we don't tend to see the Reserve Bank take only 6 months between the last cut and the next hike. So, yes, certainly an unusual set of circumstances at the moment.
Yeah, as you say, it's a big U-turn in the cut from August to now a hike in February. I mean, was the August rate cut a mistake? Is the RBA's credibility at stake here now that it's had to hike in such a short period of time?
Look, there is certainly a possibility here that that obviously that last rate cut wasn't needed. But to be fair to the Reserve Bank, that was not obvious at all at the time. In fact, it looked like the inflation numbers had been coming down quite nicely. Now, obviously, that's not turned out to be the case, but there's a few sort of moving parts in the economy right now. A cash rate of 3.6% we thought was basically around neutral. In other words, it probably wasn't, or we didn't think that it was sort of pushing up inflationary pressures or bringing them down. But it turns out that actually that might not have been the case. The economy just can't sustain too much stimulus at all before it starts sort of breaking out, unfortunately, in the form of inflation. So, the Reserve Bank certainly will be adjusting its inflation forecast to take account of that. And certainly it looks like they did certainly underestimate how bad those inflation pressures were.
And Sherelle, we're just bringing up a chart of the most recent rate moves, which shows those 3 interest rate cuts stepping down from the peak of 4.35% coming down to the 3.6% we saw in August last year. Those moves were in February, May and August last year. And that very quick turnaround, which is a perfect U-shape on our graph, of now back to 3.85% in February. Now, in terms of this turnaround, do you think it's a recalibration in policy? Do you think we're one and done, or do you anticipate we could see more rate hikes from here? The market is pricing into by September.
I think it certainly could result in more rate hikes because the inflation problem isn't under control yet. Of course, what we need to do is watch the data as it comes through. I must say that the data that we've had so far this year has probably surprised me a little bit to the upside just in how strong it's been. And that, of course, tends to be something that runs in line with stronger inflation, and particularly the labour market, where the unemployment rate fell again to 4.1% from 4.3% in December. That was a bit of a surprise. We've even seen things like job ads pick up again. So it does seem like the economy is just running a little bit too hot. Now, that certainly will be tamed by this rate hike, and in fact, the possibility that households were expecting that may have started to impact the data already. But again, we just have to watch how the data unfolds over the next few months. But yeah, I certainly wouldn't rule out another rate hike later in the year.
Sherelle Murphy, thank you so much for your quick reaction.
Thank you.
And Rose, back to you.
Thanks, Alicia. Well, the Federal Treasurer Jim Chalmers has been responding to the RBA decision in the House of Representatives. Let's hear from him now.
Today, as expected, the Independent Reserve Bank has increased the cash rate by 25 basis points. Now, this will be difficult news for millions of Australians with a mortgage, and we understand the pressure that this puts on Australian families and businesses. Now, while today's decision was widely expected, obviously that doesn't make it any easier. We know that many Australians are doing it tough, which is why we continue to roll out responsible cost of living relief, including a further tax cut this year and another one next year, both of them opposed by those opposite. At the same time, we're doing what we can to strengthen the budget and address our long-standing productivity challenge. Now, our mid-year budget update showed the budget is more than $233 billion better than we inherited from those opposite. And part of the reason for that is $114 billion in savings since we came to office, including $20 billion in the mid-year update, Mr Speaker. Now, I want to make it really clear to the House and to people watching from home, Mr Speaker, that the statement released by the Independent Reserve Bank explaining the decision that they have taken today does not mention government spending at all. It doesn't mention government spending at all, Mr Speaker. In fact, it makes it very clear that the pressure on inflation is coming from private demand. Let me make this really clear. This is the Reserve Bank Board in their statement just released, Mr Speaker. Growth in private demand has strengthened substantially more than expected, Mr Speaker. This is the point that the Reserve Bank has made today. Pressure on inflation, the big contribution to growth in our economy, is coming from private demand and not public demand, Mr Speaker, and that is clear. And in the statement on monetary policy, which the bank has also released today, they said that the upgrade to the near-term outlook was due to stronger private demand. They said the near-term upward revision is driven by private demand and that the contribution of public demand to year-ended GDP growth has continued to ease in recent quarters, as expected, Mr Speaker. So what we've seen in our economy is public demand in retreat over the course of the last year, private demand growing strongly, and that explains the additional pressure on inflation, Mr Speaker. Now, I want to make it clear that even though inflation has moderated substantially since those opposite were in office, it is higher than we would like. We've acknowledged that since the data came out. Some of that is temporary pressures, some of that is more persistent pressures. All of that is adding to the pressures that people are feeling around the country, and that's why our cost of living relief is so important. That's why it's so important that we've got the budget in better nick than those opposite left us.
Call to the
That's
Leader
Treasurer
of the
Jim Chalmers. They're reacting to the news this afternoon from the Reserve Bank that rates are being increased by 1/4 percentage point to 3.85%. Well, let's go now to our business correspondent, David Taylor, who is at the Reserve Bank. David, you've had the chance to look at the accompanying statement. We heard snippets there from the Treasurer and also from economist Sherelle Murphy a short time ago. What stands out for you?
Well, it's interesting, Ros, because if you're looking at, as I mentioned before, the Reserve Bank's mandate, it's to get inflation between 2 and 3%, and preferably bang on the midpoint of that, so 2.5%. And it's not acceptable for the Reserve Bank to consistently have inflation not only not within the band or even at the top end of the band, but above it. So to give viewers an idea from it's almost a little bit abstract, but to give people an idea. Inflation, underlying inflation, which strips out all the volatile items, strips out all the bumpy data, that underlying inflation figure has been around about 3.5% to 4% now for quite some time. And it's just not good enough. The Reserve Bank says it needs to hit the midpoint. In order to do that, it needs to make spending more difficult. How does it do that? It raises interest rates so that mortgage borrowers think twice about spending at the stores. And that's what Treasurer Chalmers was just focusing on in the House of Representatives, because if you're looking at overall demand in the economy, which is what the Reserve Bank does, it doesn't look at individual sectors and who's performing well and who isn't performing well. It looks at aggregate demand. And so that's households, it's businesses, and it's the government. And so what Treasurer Jim Chalmers was just saying was that the Reserve Bank excluded the contribution from the public sector, and it focused, which it has in the statement, the RBA is focused on the contribution from business investment and household spending. So we saw at the end of last year, Cyber Monday did very well, Black Friday did very well. People brought their spending back from Christmas. Credit data in the economy is showing robustness in terms of household spending and business spending and things like that. So that demand is what the Reserve Bank says is too strong. Now, on the other side is supply. So businesses producing enough in order to meet the demand from consumers, and that isn't strong enough. We know that because productivity is too low. So demand is too high, supply is too low. And that means, and what the Reserve Bank has said is that, and as Sherelle Murphy pointed out, it means that inflation is remaining materially above the Reserve Bank's target, and it is going to be there, the Reserve Bank says, for quite some time. So in that sense, a rate cut is obvious. But just to make one final point on that, if you're looking at the way that, I guess, you could achieve lower inflation, part of it is to improve the supply side of the economy or reduce demand. So the rate hike will supposedly help in reducing demand. The question is, how do we ramp up productivity so that we do potentially get rates on hold or rate cuts later this year? The problem, I think, from this statement is that there's every suggestion that there may be a follow-up rate hike, Ros.
Finally, let's go back to Alicia Barry for the market reaction to this news.
Yeah, Ros, as David said, the board is really going to be watching the data, and it certainly has left the door open to do what's necessary to keep inflation under control. As for the market reaction, it's taken this decision from the Reserve Bank to push the dollar higher, essentially. The Australian dollar has gone from 69.65 US cents to 70.13 at the moment, on account of probably looking at that statement as well and looking ahead, thinking that there is the potential for another rate rise. The market has done the converse, which it tends to do. It doesn't like rate rises. It's hanging on to some of its gains, but it's now about 0.75% higher, down from the 1.1% stronger it was ahead of this decision.
That's where we'll leave our rates coverage. Alicia Barry and David Taylor, thanks to you both.